Hello, good afternoon. I'm Michelle Cheong, who is a global lead of Rating Express product development. I'm joined by Jian Huang, who is the head of product in China. Today, we'll be covering evolving credit risk insights from data and workflow enhancements. We plan to cover the following: emerging trends on the use of data for credit risk analysis in China and across the globe. Secondly, if you have content on your platforms, does databasing matter? We then go through 2 ways to gain insights on credit ratings data and content, such as combining financial statement data and S&P Global's ratings criteria via scores and factors, and also an example on text analysis in S&P Global Ratings Research, as well as transcripts and news and the roles each one plays. Across the globe, market participants have fed back to us that COVID-19 has become a catalyst in using credit risk data globally. In addition to the need for risk management and surveillance, we observe the following trends. A, rapid automation and the use of data globally, especially in the larger players. Now, whilst there's a lot of talk about bots replacing humans, what eventually happened is that automated processes supplemented, but didn't fully displace the use of web-based platforms, which are still used to take a closer look at entities and develop visualizations. Work from home arrangements post-COVID-19 increased the demand for login-free or human intervention-free means of obtaining data and analytics. Some of our clients now really see the use of in-house built API to supplement platform web interface as ways to improve business continuity and continue running these processes when some employees are no longer able to work. In the job market, we are seeing an increased hiring of data scientists, over and beyond just quants in investment management, playing the following roles. The ones highlighted in red are new processes, and the ones highlighted in black in this slide are just been there before COVID. The first one is increasing efficiency and streamlining processes, stress testing and scenario analysis, especially with macroeconomic instability, early warning indicators, tracking sector and industry trends within and outside geographic regions of companies, screening and filtering, and in general, bulk processing of information, and also developing sentiment indices using unstructured data. Last but not least, building proprietary decision-making criteria to reduce amount of human work. How is China, which is at the forefront in the adoption of technology and automation using credit risk data? We now turn over to Jian, who heads up the product in China.
Thank you, Michelle. We would like to highlight a trend on the use of credit risk data we are observing from the China marketplace. One key trend is the increased utilization of alternative data in credit modeling and surveillance. While traditional data like company financial are still the cornerstone, while building and driving the fundamentally based credit analytical model, alternative data like payment data, sentiment data derived from earning transcript, company announcement, news and social media has been gaining traction in the credit modeling space, as well as for ongoing credit surveillance. One related trend is that as the volume of the data increase, coupled with the adoption of mostly unstructured data, data science and data analytical tool has been taking the center stage of maneuvering, analyzing, and to be used to generate insight. With regards to the conventional data, especially the company financials, we see continued demand on analytical and insight around accounting fraud detections. Currently, there is no consensus around how to systematically detect those potential accounting manipulation, so that remain a developing area. Overall, with the ever-increasing number of new data sets, it is becoming more and more important to have a robust process for data asset governance and management. This would involve cleaning, standardizing of the newly introduced data set, linking of the relevant data set, including the new one and the existing data set, also for the ongoing data quality check. Monitoring and governing a company's data asset has also become more and more important in every type of companies. To this end, we observe change in the implementation of so-called data middle platform, or middle data office, or data as a service DAS. Going to the next slide. In relation to the trends we discussed earlier, we would like to highlight the data requirements that we observe in the China market. First and foremost, we will be risk stating the obvious here, but compliant with the regulatories while storing, processing data in credit modeling in China, to be frank, in any other country, has always been the #1 priority. There are a wide range of relevant regulatory requirements, which include, but not limited to, personal privacy data protection, cybersecurity, data security, data export, to name a few. A robust credit modeling and monitoring will nowadays require the input of both traditional data, like company financial, and alternative data, like payment transaction and or sentiment data. Data with higher frequency and lower latency are desirable, especially in the risk surveillance use cases. Big data and alternative data are inevitably noisy and unstructured, which makes the quality of the data utmost important. There has been some debates over whether or not big data need to be cleaned before analysis, but in any case, having the quality traceable data is one way to avoid the garbage in and garbage out situations. In order to navigate the large number of data sets and generate useful insight, data science and analytical tools that normally involve machine learning, AI, are required. As an example, a set of machine learning-based natural language processing, or NLP, algorithms are required to process and analyze text documents to extract sentiment information embedded in the document. In the case of analyzing company announcement in the Chinese stock market, just to give you examples, the tool become a necessity when there are thousands of announcements every day, with some reports could be as long as 150 pages. Now back to Michelle to talk about the data versus content requirements. Michelle.
Thank you, Jian. If we can get the same content from different sources, one question we get asked by a lot of market participants is, does it matter where we get the data from and how it's stored and delivered? We'll use analogy in house building. The exterior of the house and the furnishings is the content. It provides a view of the world, and researchers and developers can synthesize this content via charting and analytics and research and insights to gain a view from the world using this data. Well, this is the visible layer and what the end user sees. But beneath the surface, acting very much like the foundation of a building, where the building structure itself could evolve in the future, there are a number of important considerations in designing databases and delivering data. Some areas under consideration are reliability, coverage, latency, availability, security, reliably and accurately archiving the data with the appropriate timestamps, which matches the point the decision make and the information is made public. How informative is this data and the content? Is it noisy? And how much do you need to spend time treating it? And finally, organization. And does it require a lot of resources to retrieve this data? All the above can impact the value of data assets. In recent days, we see an interest in stress testing and scenario analysis. One commonly used approach is to simulate the impact of previous stress events and look at credit ratings to assess portfolio level resilience to shocks. If credit ratings are measures of resilience against shocks, Then the building blocks of these ratings can help us fine-tune the types of shocks these entities are resilient to. So we create a database called Scores and Factors to really break down these ratings into the building blocks. The advantage of using these scores is that it's a metric that's already normalized to be apples to apples comparisons across geographies and industries. So we'll show some examples here using the energy industry. On the left-hand side, you see the cash flow and leverage scores of rated energy entities across the globe. Now you can see that in fact it's quite skewed, with a number of entities scoring at aggressive and highly leveraged, which are the worst two scores. On the right, you can see that liquidity is slightly more benign, with most of them inadequate. But these could indicate exactly why there's a lot of defaults happening in the energy sector in the last couple of months. As a risk manager, you can have run a negative screen to weed out entities with the weakest cash flow and leverage scores. Applying a similar approach to banks, we can use the BICRA or Banking Industry Country Risk Assessment scores, and then look at countries' levels of systemic risks. This can tell you how well a country can actually weather borrower defaults as they start to strain the system, which is what we're seeing now. In this chart, we asset weighted these bank-specific scores and aggregated them up to the country level, so that if the bigger banks had poor liquidity, it would show up more prominently in the chart. For the most part, post 2008, 2009, you can see that most of these countries have pretty much handled their bank capital and earnings and have adequate funding, with a couple of exceptions in emerging markets. Finally, in an environment where industry participants need the government to bail them out, a government's fiscal assessment could inform us of the ability to provide fiscal stimulus without resorting to aggressive borrowing from governments, effectively carrying over the problem from corporates to governments with excessive leverage. So we look at both fiscal performance and flexibility, which looks at borrowing trends, assets and revenue base of governments, as well as down the rows, the debt to burden, which measures debt to GDP, interest cost versus government revenue, and access to funding. Now in this chart, we have a heat map. So each one of these cells represents the number of sovereign governments following in between these two buckets. You can see that whilst the majority of these countries are in the top left corner with stronger fiscal scores, there are 5 countries with the worst fiscal position scores in the lowest right. As Jian has mentioned earlier in the presentation, the last few years has also seen an increased adoption in the use of unstructured data, such as sentiment indices on text and indicators using global maps, etc. Now, what drives the value of these machine-readable credit ratings research and text? Can we design the data in a way that it is stored and to help end users more easily develop algorithms around it? Whilst news articles and Google search buzz posts can be filled with noise, are prone to herding effects, and have statistically been proven to have short shelf lives in the market, transcripts and credit research both proved to have a wealth of information that could have potentially have longer persistence. This chart here indicates the number of times COVID-19 or similar texts are mentioned in earnings calls globally from January to June 2020. You can see that for transcripts, it is picking up in March 2020 and continue to be mentioned as earnings drivers during subsequent earnings reports conference calls. This tells you that companies do see COVID-19 theme impacting forward-looking earnings from the time to come. A similar persistence in the reporting of COVID-19 is seen in credit research reports by S&P Global Ratings, which also distills investor feedback and are generally less noisy than news and media reports. Our reporting ramped up substantially in March 2020 ahead of the peak in transcripts in May. And more importantly, the text content in credit ratings research is designed to be concise and precise in its delivery, which also increases the informativeness of the text content by word count. Can we organize these valuable text-based content sets so that it is easier for machine-based algorithms to find the required information? Well, we can take advantage of a couple of features within S&P Global Ratings Research to form our database. The first thing we see is that the articles are presented in a structured format. So here's an example of a ratings research article, and you can see that the sections are clearly marked. The entities and authors are also clearly identified, which allows you to actually adjust for the author's inherent optimism bias and the changes in how they feel about the entity. We also tag the sections and also indicate you can cross-reference your industries and geographies so that you can run better text analysis around peer comparisons and run industry and country level aggregations on these sentiment indices. Finally, you can also isolate the sections that you want. So maybe business description may not give you a lot of forward-looking information on credit risk of Macy's, but perhaps downside and upside scenario sections could be more informative. Your algo can actually skip to just the sections they need. And therefore you can discard those which don't inform credit quality. Thank you for attending today's presentation. Now we'll turn over to Q&A.
I see a question coming up. Let's see, the first question is for you, Michelle. In what way do you see this insight from credit risk research differ from sell-side research and market blogs?
Thank you, Jian. I just want to elaborate a little bit more on what was said earlier. So if you think about market blogs, they tend to be more sentiment-driven, the flavor of a day. Sometimes some of these bloggers may or may not always check the sources. And it's very much a quick reaction to recent events. So in general, they do, in previous research, is shown to have a pretty short shelf life. It could induce market reaction in equities, maybe for a couple of days, and then the market then focuses on something else pretty different. Now, where it could be useful, however, is that if there's any in what we call in S&P Global Market Intelligence, what we call key developments and distress signals / scandals, sometimes market blogs catch on those pretty quickly. So it could be interesting as a quick blip on the radar. Now, when you look at sell-side research, for example, it's seen to, analyst recommendations and sell-side research have been seen to move what we call market indicators of credit risk. So in S&P Global Market Intelligence, for the unrated entities, we offer an indicator called the equity volatility pays probability default market signals. And the way that indicator reacts is that it spikes and the PD jumps whenever there's a blip that's significant enough, they actually detrended for noise. But what it does is that gives you a blip whenever there's a potential, a flag for a change in future credit risk fundamentals, even before the next earnings reports come out. So some of these sell-side research could potentially be tested for sentiment indicators and sentiment indices, and we'll leave it for the market participants like yourself to really look through the research for value. Now, S&P Global Ratings actually plays a different role in the market. Oftentimes, there are issues that have already appeared on blogs or maybe even sell-side research. The investors come and ask our ratings analysts, what do you think about these issues? And so there's a subset of digested, pertinent credit risk FAQs. And just like credit ratings are a longer-term indicator of credit risk, the research itself also tends to have a flavor of indicating what are long-term, more persistent long-term trends. So one potentially interesting use case for text mining, just in the same way that we look at COVID as an example of a trend, is to really see whether you can develop word clouds or even work aggregators of key themes that cut across companies in the same industry across geographies, because S&P Global Ratings has a franchise across geographies, right? And then so therefore, if one analyst talks about COVID in one country, then they can start to rethink about COVID in another country affecting the same industry. And similar key themes that could have contagion effects could also be interesting just from picking up the text. And that gives you actually an early warning of really important shifts and trends that can affect companies across the globe. Now, what is interesting here is that if you look at blogs and even to some extent sell-side research, a lot of it is really driven by company-specific information. But if you look at the word cloud version and if you do text analysis on ratings research, they actually, if you look and aggregate down up to the country industry level, they apply not only to the S&P Global Ratings rated entities, but they also apply to those which are not rated by S&P Global. So I think in a sense, they play different roles, even though all of them are bunched together as so-called text analysis. So hopefully that answers the question. Let me take a look at one that just came in for Jian. There's one audience who asked about what ways, how would you suggest a vendor like yourself to manage regulatory requirements, say a cybersecurity law and the upcoming security law in China? Over to you, Jian.
Right. Thank you, Michelle. Yeah, that's a good question. As mentioned, right, navigating in any jurisdictions, like especially in China, the regulatory requirements is quite essential for us to make sure that we adhere to that. And I think with that one, like the data security law, is the upcoming law, which I think they are asking for opinion discussion we could enforce soon. What we would suggest is to, number one, establish an internal working group to go through your data inventory to ensure that the items you have, to categorize them, whether they are governed by these new laws. And then having a consultation with an external counsel to ensure that understanding is aligned. Last but not the least is to actively engage with regulators and discuss the matter with them. So I'm sure by going through these 3 steps, going to ensure a company we holding, either owning or distributing data assets, going to be adhere to the local regulations. Not to mention, this is key for us to for any vendor to operate a data business in any jurisdictions. Right, I see a next question coming up for Michelle. Michelle, you mentioned about the machine readable credit research, but how exactly would a client access those credit research?
Sure, thank you, Jian. We actually offer what we call bulk quick delivery of these research articles in PDF and XML format. So, and that the articles themselves can be downloaded by FTP. And we have about 900,000 over articles. Now, the way we actually deliver what we call the indexing files, which is what we call metadata, to help you search out the different sections. And that is available via our bulk data feed. So it's via ratings research from ExpressFeed. So I'm happy to talk offline as well. Just feel free to indicate to organizers after this presentation. Okay. I have another question for Jian. The person would like to find out what are the typical types of alternative data that is used in credit risk modeling and how can they be applied?
Right, that's a good question, which will include new social media company announcements. And generally, extracting a sentiment score is step 1. Step 2 is actually trying to link those scores into a forward-looking credit model, be it a standalone credit model or be it a overlay model onto the existing sort of credit analytical algorithm. So that's one. We mentioned about the payment and transaction data as well, and that's used to measure the liquidity status of a company's And those are the behavioral data, which is used to gauge the willingness and the abilities for a business to repay the debt. Some other alternative data that could be used from talking to the marketing participant, and something we're looking into is satellite data. For example, the freight data that shows cargo shipment activities, satellite data that monitor and storage amount of crude oil in the crude oil storage tank, and also the nine lights satellite data that shows the brightness and the distribution of the 9 lights of a city, which can be used as a proxy to gauge the economic activities in the region. So you can use as a proxy to manage to gauge the local regional governments' strengths in their income capabilities. Some other geolocation and foot traffic data can be used to check the attractiveness of a business or the traffic movement of people visiting a shop. Let's say daily visitor of a coffee shop chain in China or in anywhere of the world. Number of the people passing, let's say for one particular example, number of people passing the Macau custom, actually someone actually been using that to measure the profitability of the casino companies, the casinos operating in Macau. Some other e-commerce data which provide a GMV of a certain brand to predict the revenue projections of the company even before the earning announcements. I think those are, and from the revenue and earning strengths to project their credit worthiness on that. So these are the typical type or some of the alternative data that we came across that client user could be using to model their credit risk. Right. I have a last question so far is that there are already good measures of country risk. Michelle, you mentioned about BICRA. What does the reverse engineering of the bank credit ratings add to the analysis or add to the insight?
Thank you. I think that's a great question. If you think about, I know that there are a number of our competitors also offer, their flavor of country risk scores. And in the end, if you just think about what is the difference, is really what are they trying to measure? I know that some vendors out there look at maybe focusing a little bit more on political risk, or they may be looking at different other aspects. Now, whereas within the S&P Global Ratings framework, it all goes down to what are you trying to measure at the end of the day. So it is really to measure an entity's resilience to shocks. Like right now, we're going through a macroeconomic contraction. We're going through shocks to the economy. So in the end, the end goal for a rating is to really look at how resilient your entity is to volatility in earnings and in economy. Now, the country risk scores, whether it's corporates, insurance, and also banks, they go into what we call the country risk scores, which measure the underlying systemic resilience to shock events. So it's also more credit risk focused and focuses on the risk of default. So then if you put it back into today's current context, which is COVID, banks, some of the factors that go into these country risk scores are, for example, for banks, looking at the inherent credit risk in the economy. Is there already overborrowing? Right? Is there actually market imbalances? Is there a real estate bubble going on in the country itself? And looking at corporates, if you look at the country risk scores, their flavor of country risk scores, you're looking at things like governance, education, political risk, also, whether there's any regulatory or uncertainties in the political environment, rule of law, and so forth. And these could lead to fragility in the economies, and therefore the corporates themselves could be impacted by much more affected by the same shock event as to the ability to weather these shocks whenever let's say the country is politically unstable. What is it? Economic contraction could soon become political unrest, which further hits your entity's revenues regardless of how good they are and how robust they are going into the crisis. So in short, I think if you look at really the country risk scores that are offered by S&P Global Ratings, two things. Number one, it's very credit risk focused, really focused on the risk of defaults and systemic defaults in the country, within the country's banking system or within corporates, depending on which flavor you use. And secondly, it's really a lot more credit focus. It's a lot more focused on defaults rather than just looking at something general like your geopolitical risk indicators that looks at the risk of something breaking out, some riots breaking out, and giving you early blips of riots breaking out in isolated places. I hope that answers the question. And if not, please feel free to, again, contact me after the event. And with that, I do see that we've gone past our 30 minutes of time. And any concluding remarks? If not, again, thank you very much for, I think this is really exciting time that we're in, and when we start to look, as the world starts to focus on these systemic and really unstructured and alternative data sources. If there's one thing that we want to take away from this is that it is important, how you source the data. Data sourcing is important, not just the content. Okay, thank you very much. And I thank you, Jian, for joining the presentation.
Thank you, Michelle. Thank you all.